Many ETFs use covered call options to generate more income. We're normally attracted by their insanely high yield distributions. And Global X recently launched 3 covered call ETFs. In this video, let's break it down. What is a covered call ETF, how it works, and more importantly, should we jump onto it? My name's Irene, let's get started. So what is the call option? A call option gives you the right but not the obligation to buy a stock or any investment at a certain price before an expiry date. So here are 2 parties here: the seller who owns the stocks and the buyer who wants to buy the stocks at a favorable price. The agreed share price $185 is called the strike price or exercise price, and $5 per share is the fee to give you, the buyer, the right to buy the Tesla stocks, which is called the premium. Please note that I got to keep the premium regardless if the option is exercised or not. Before the expiry date, if Tesla is trading at $200 a share, of course you want to exercise the call option and buy the stocks from me at only $185, and you would profit $10 per share. If you bought one option, which is the contract that represents 100 shares, your profit would be $1,000. Now, if before the expiry date, Tesla is trading below $185 per share, obviously as a buyer, you don't exercise the option, but you already paid a premium of $5 per share times one contract, 100 shares, you will lose $500. From the buyer's point of view, when you go long the call, your outlook is bullish on the stock. In other words, that you expect a rise in the stock price while you lock in a cheaper price with the seller. The beauty of a long call is that you have a limited loss, which would be the premium if you decided not to buy, but unlimited potential gain if the stock's market price keeps going up. Selling or writing a call option like what I did is another way to trade call options. It's also called short call option, and short call strategy can be used when you think the stock prices are unlikely to rise much further in the near term. There are 2 types of short call options: the covered call options and uncovered call options. When I sell a covered call option, I already own the underlying assets for the call. If the option is exercised, I will be forced to sell those stocks as agreement. If the option is not exercised, I got to keep the stocks and the premium. On the other hand, selling uncovered call option is a scenario that I don't own the underlying stocks when I sell the call. So if I sell an uncovered call, or people call it naked call option, if the option is exercised, I would need to do some magic to buy those stocks on the open market with the rising price at last minute to make the selling transaction happen. It's like somebody paid me a deposit to buy my house, and I took the money, and when the buyer is ready to pay off the rest, I say to the buyer, sorry, I don't own the house, and the house price has gone up. Normally, the short call option used by the seller is based on the covered call options. The biggest drawback of the covered call strategy is that it's got very, very limited profit potential. Its maximum profit per share is when the call is exercised, but the loss potential could be substantial if the stock price keeps going south. So what these covered call ETFs do is to purchase a bunch of stocks normally following an index. For example, the QYLD, which was introduced to Australia recently, is the biggest covered call ETF in the US. Its underlying assets are Nasdaq 100 stocks. So they buy these 100 stocks and sell short-term calls, usually less than a month. So when we buy a covered call ETF, the high yield distribution is made up of the dividends of the stocks the fund currently holds, the option premium, no matter the options are exercised or not, and the capital gain profit if the strike price is higher than the cost base. Now, let's talk about the pros and cons of buying a covered call ETF. Obviously, the main reason investors buy covered call ETFs is for the high yield. And we can see here, by writing covered calls, you can earn additional income no matter the options are exercised or not. And if you are an investor who does active management, covered call ETFs can save you time to sell individual covered calls as the fund does it for you, although that you have less control. And you will find the covered call ETFs is less volatile than the ETF that holds the same underlying assets. The biggest disadvantage of covered call ETF is its limited profit potential. Like what we discussed earlier, the maximum profit of a covered call is achieved if the stock price is above the strike price. That means that the option is exercised. As the writer, I take the capital gain profit as well as the premiums. However, by doing that, I also give up the opportunity for the upside gain. So I instantly lose the gain that I could have earned. On the other hand, if the stock price goes south, which the call would not be exercised, if in extreme circumstances the company could go bankrupt the stock price can lead to $0 and my loss potential would be huge. And it's very unlikely the premium will offset my cost base. So when we use covered call strategy, what we really want to see is the price go sideways. Not much higher so that we have a huge opportunity cost, not so low that the value of the holding stocks will decline too much. Another drawback of a covered call ETF is its high management fees or high expense ratio due to the frequent buying and selling activities and capital gain tax as well as the active management. High yield also means more income tax unless that you keep it in a tax deferral retirement account. If not, this additional income tax is not necessary, especially if you're in the pre-retirement wealth accumulation phase. And last but not least, covered call ETFs generate disappointing total returns, which you will see the data in a minute. Due to the nature of the covered call strategy, the fund focuses on the income generation, the income return, while compromising its capital growth. Therefore, the total returns of covered call ETFs are not as good as normal index ETFs that are riding the calls with. I think we talked enough about the theoretical stuff, and should we consider covered call ETFs? Let's look at the actual products. On the 30th of January, Global X launched 3 covered call ETFs, QYLD, UYLD, and AYLD. QYLD and UYLD had their parallel ETFs that have been trading in the US for 10 years. And AYLD uses ASX 200 index as the underlying stocks. Actually, before these 3 covered call ETFs, beta shares have QMAX, UMAX, and YMAX that also use covered calls. What I'm going to do is to divide them into 3 groups based on their underlying index, Nasdaq 100, S&P 500, and ASX 20, and I will compare their past performance with the actual index ETF. First, let's look at QYLD. Since the ASX QYLD and QMAX are relatively new, and we'll compare the US QYLD and QQQ. And QYLD is one of the biggest funds using covered calls with 6.78 billion AUM so far. The 12 months trailing yield does look very attractive. The distribution is monthly, which I assume that it writes 100% of the portfolio in order to maximize income. And we can see the share price peaked around $25 before drifting down to the high 10s. Let's have a look at the total return. Hopefully the yield will make it up. $10,000 invested in 2014 will turn into $17,045 for QYLD and $36,286 if invested in QQQ. And QQQ's compound annual growth rate is more than doubled of the QYLD. Although QYLD is a lot less volatile, QQQ still has a better risk-adjusted return. Next, let's look at S&P 500. If we create 2 hypothetical portfolios, one is 100% XYLD, the other is 100% SPY that both purchased $10,000 worth of stocks on the 1st of January 2014 at the market price. And XYLD's income return is almost 3 times of the SPY, but if we look at the total return, SPY is more than doubled of XYLD, which means that there's a significant loss on the capital growth. Lastly, let's see YMAX, beta shares equity yield maximizer, which writes covered calls on 20 largest blue chip shares listed on the ASX since 2012. Surprisingly, the yield return is almost the same. However, YMAX is losing capital. So all 3 comparisons point to the same thing. Although the yields of covered call ETFs are amazingly good, the total return cannot be the actual ETFs that they are writing the calls with. Now, I can understand some investors who are chasing the yield, but the high yield shouldn't compromise the capital growth. If you think about how call options actually work, if I expect the underlying stocks or index to rise in the long run, I should long calls, not writing cover calls, right? My name is Irene. I'll see you next week. Bye.